Happy New Year, everyone. 2023, it's going to be a blast. Now, what do I have for you to start the entire year? It wasn't the Tesco's video. That was released prior to the good old 2023 countdown. Instead, I'm going to do a completely off-the-cuff video on the best British shares to buy in January. I stumbled across this wee article this morning on the Motley Fool. Highly recommend you check it out, even to just blitz through it to see, you often find a company you've never heard of before, and it's so interesting, at least I find personally. So that's why I thought I'd make this video and we'd go through what the Motley Fool staff think are the best shares in January. Of course, don't take any of this as, financial advice from any of them. I'm sure they have enough disclaimers everywhere. I don't have to say that, but I always feel, it's a nice thing to add. Right, some of these companies I know very well. Some I've never heard of before. I think that is like a brilliant aspect to it. So, let's jump into it, shall we? We've got 4, 5, we've got 12, 10 or 12 stocks. Yeah, so let's jump into it. Harbour Energy, that's the first one. What do? They're a North Sea energy firm, and it's the UK's largest oil and gas producer, which has operations in Mexico and Indonesia. There you go. I didn't know that. Funny enough, Harbour Energy. I don't know, I've never really stumbled across these guys. Let's see, the outlook has been transformed by the oil and gas boom. Production rose by 27% to 207,000 barrels of oil equivalent per day during the 9 months. Operating costs have stayed low at just $14 a barrel. As a result, the firm is expected to report a record profit of around $1.4 billion this year, on sales of $5.4 billion. By the end of 2023, management expect to have completely repaid the group's net debt of $1.1 billion. Okay, that's pretty good. The risk is that oil is a boom-bust industry. High prices won't last forever. Some of the firm's oil and gas fields are also getting old, and they'll need decommissioning. Something to always bear in mind with energy firms. These factors probably explain why the share price has fallen, but the shares are now trading at 2.7 times forecasted earnings with a yield of 6%. Okay. He does not own any shares. Nice to know. So we can have a wee look at this, and I will, of course, bounce over to one of my favourite resources, Simply Wall Street, and we'll just have a wee look at the snowflake, maybe look through anything I find particularly interesting. Won't do super deep dives on them. I want to get through them all. So, independent oil company, we know that. They're down 14% in the last year. Market cap at $2.6 billion. Okay. And the share price is £3. Ticker symbol HBR. Well, their snowflake sits at 5 out of 6 in value. They score 3 out of 6 on their dividend. Financial health, 2 out of 6. And past performance, 3 out of 6. They actually score 0 on future growth. As it said in the article, boom-bust industry. I'm sure the high prices are forecast to go downhill with a bit of a bang. We'll just look at the general summary here. So we know they're trading at 26% below their estimated fair value. That's a discounted cash flow model on Simply Wall Street. They became profitable this year, trading at a good value to peers. Earnings are forecast to decline. They have a high level of debt, an unstable dividend track record, and negative shareholder equity. Okay. Well, that's all something to bear in mind. I will jump over to the dividend because that's one of the most important aspects of this channel, isn't it? 5.52% at the current yield, a bit below the industry average, and forecast to actually grow in the next 3 years. There you go. How have they been doing on their... They only started paying a dividend back in March of 2022? That can't be right, is it? Oh, okay. There you go. And their dividend per share has marginally increased from 1 year to the next. It is forecast to grow, though, so definitely a stock to definitely bear in mind, to say the least. Right. Who's next on the chopping board for us? Intercontinental Hotels Group, IHG. Global hotel chain. Its brands include the Holiday Inn, Iberostar, and Six Senses. Only ever stayed in the Holiday Inn. Don't know about the other two. Let's see. They're a business that ticks a lot of boxes. Warren Buffett says the best ones are that grow without needing capital. And this company fits the bill. Most of their hotels are run on a franchise basis, meaning that the company doesn't own the physical buildings itself, but takes a fee from the owner who runs the hotel as part of the IHG network. Oh, it's an interesting business model. As a result, the company has extremely low growth and maintenance costs. The running costs of the hotel are left to operators, and it doesn't have to pay to add new hotels to its network. Nice. So this makes for impressive financial metrics. It generates over 770 million in operating income and only 410 million in fixed assets, and 75% of that income becomes free cash. A very, very good cash flow business then. Let's, what's our wee ticker symbol? IHG. I should have knew that actually. IHG. Let's have a look. All right. Good old IHG. Wow, that's a very condensed snowflake, to say the least. Scoring 2 out of 6 in everything bar future growth. That's actually 3 out of 6. What's the top notable things? They are trading at 6% below their fair value. Earnings are forecast to grow 12.64% per year. And they became profitable this year. Yeah, a lot of companies it's stating profitable because obviously coming out of the pandemic, a lot of them recovered, to say the least. They have a high level of debt and they have negative shareholder equity. Okay. Dividend? 1.41%. Ouch. Kind of just below the industry average. Forecast to grow though. Let's see. Oh, so they've definitely had some good years. Whoa, 20% in 2016? 20% yield, is that right? Wow. Okay, and nothing over the pandemic, and the restarted payments back in February of 2022. Forecast to grow in the next couple of years. Alright, well, at least we had a wee nosy at that. Who is next, I wonder? We have the Big Yellow Group. Who are they? They provide secure and modern self-storage for homes and businesses. Their share price has definitely taken a wee bit of a tumble over the last year. It is on the last year, isn't it? Yeah. Currently trading at £11.90. Actually, what was IHG trading at? They were £47.44 per share. I will look more into the share prices on the next companies. So let's have a wee read and we'll jump over to Simply Wall Street. Paul Summers. This year has been pretty awful for most of the listed companies, and self-storage provider Big Yellow Group is no exception. As I type, the share price is down 35%. This doesn't come as a surprise. Statutory pre-tax profit in the first half of its financial year plummeted to 6.8 million from almost 255 million in 2021. Ooh, that's a drop. On a positive note, the Real Estate Investment Trust has stated that it has seen a correction in land prices. Unless we're about to become a nation of minimalists, this bodes well for future growth. The interim dividend was also raised, nice, leaving the stock at forecast yield of 3.9%. It may operate in a competitive space, but I reckon it has both the brand and financial stability to take on rivals. Okay, BYG, let's see. BYG. They score 5 out of 6 on their dividend. Nice. 4 out of 6 in valuation, 4 out of 6 in financial health. So, yeah, that normally fits a lot of the metrics I personally look for in my own portfolio. So this should be quite interesting. The word trading at £17 and now at £11.47. The UK's brand leader in self-storage. I think I've seen some of them when I've flew into some of the airports over in London. I think I've seen that massive sign. Anyway, enough about my travels. Trading at 9.1% below its fair value, right? Revenue is forecasted to grow, pays a reliable dividend, and it's trading at a good value compared to peers in industry. Now, they are forecast to decline by 12% for the next 3 years, and large one-off items impacting financial results. Right, let's jump down to their dividend at 3.89%. So it's everything bar high. And its ex-dividend date is January 5th, 2023. And as you all know, you would need to buy in the next 3 days. So you need to buy before... You need to buy on the 4th if you wanted the dividend. It's always a day before the ex-dividend. I always like to stress that in case anyone, buys shares on the 5th and wonders why they aren't paid on the pay date. Yeah, let's see the rechart. So, turquoise line, dividend per share. Light blue, dividend yield. Here. It's been growing its dividend per share year on year for at least the last 10 years. I like that. That's good to see. Right. Now, the next one is really interesting because I had a wee bit of a scan through this article and we got YouGov. Now, They are, I'm sure you've seen YouGov polls on everything. Global public opinion company specializing in market research and data analytics, which the last two, they're extremely important. Data is a bit like oil. Into the future, it'll be a bit like oil, if it isn't already, I suppose. Now, they were trading at the start of the year back at about £15.87. They're now trading at about £10. Right. I know they don't pay a dividend, I know that much. The mission at YouGov is to become the world's leading provider of marketing and public opinion data, and it has been making great progress in that regard. Both its revenue and operating profit has more than doubled in the last 5 years. Its 2022 full-year results ended 31st of July. All three divisions recorded double-digit growth on an underlying basis. YouGov is now truly global with operations across, everywhere internationally. Its product, reliable and trustworthy opinion data, is highly valued by companies, governments and organisations. One consideration is that YouGov are trading at 30 times forward earnings. That isn't cheap, even after the 33% pullback this year. However, profits are expected to rapidly grow over the next few years. January might be an opportune time for me to buy some shares. So he does own shares in YouGov. Nice to know, at least when you're reading through an article. U. Ticker symbol U. What a nice ticker symbol. Let's see. Obviously, we can't look at the dividend yield because they don't got one, but their financial health is 6 out of 6. I must actually go down and have a look at that. Past performance, good. Future growth, good. Value, it's all right. You can take it or leave it at that. 2 out of 6. Trading at 7.2% below its estimated fair value. Earnings are forecast to grow 37.56% per year, and they've grown more or less the exact same over the last year. Analysts are in a good agreement the stock will rise by 35%. I never really like it when I see analysts are in good agreement, but, sometimes maybe they might be right, but I always take that with a grain of salt. There's a lot of things with investing you take with an absolute grain of salt. And significant insider selling, I actually want to have a look at that too. Financial health, 95 million to 90 million in short term, 145, okay, they're crushing it in the long-term assets. How are they in terms of debt? They have no debt. They're debt-free. They have 37 million in cash. Wonder, have they ever paid a dividend? They do. Oh, they do pay a dividend. Oops. My bad. Sometimes I see 0 out of 6, and often it means they don't. But I guess they just scored really bad on it. 0.69%. Won't laugh at that because I'm not childish. Good time for a coffee break, I suppose. It's Starbucks. My sister works there. Free drink. Okay, this one wasn't free, but they usually are. We can see here that they've been growing their dividend per share, I suppose, for the last 10 years. It's forecast to continue. I mean, the yield still sits at about 0.75%. That's lower than most, it's close to most savings accounts at the moment. So, something to bear in mind. What about this insider trading? 2 individuals sold 2.7 million in the last while. Is that considered an awful lot? Nah. It's nothing major. I love how someone bought 21 shares at just £306, but they had to note that down. Then he went on to sell 200,000 on the same, or a few months later. All right, fair enough. Right, back over. Who's next? Spirant Communications? SC. What's their ticker symbol? Oh, SPT. I thought it would be SC, but what it does, Serpent. I'm gonna I butcher words sometimes. That's got me. Maybe I need more coffee in me. Troubleshoots and offers automation solutions for its customers, devices, network services, and security. Okay, let's see. Over the last 5 years, SPT has grown its revenues by 5.9% each year on average. Maybe that's not awe-inspiring. It's not the worst. I mean, growth in the midst of all this is not too bad. But the company's operational improvements in the time are impressive. Operating margins have expanded to 18.2%. Normalised earnings per share have doubled from 7.8 pence to 15.8 pence. With its customers moving to the cloud and 5G and exploring the Internet of Things, providing for remote work, SPT's services should remain in demand. It spends a hefty 22% of its revenue in research and development to keep up with the intricacies of serving that demand. And you know how much I love spending on R&D. Now, they have a dividend yield of 2.1%. Okay. Payouts have been growing at 12.6% on average for the last half a decade. Dividend coverage is forecasted to remain 2.2 for the next few years, suggesting safety, but with a PE ratio of 18.7, the stock is a little expensive compared to the industry and wider averages. He does not own any shares in SPT. Okay, it's time for SPT. Did you all spy the next one? Oh, sausage rolls are coming. Right, let's look at this first. Ah, okay. So 6 out of 6 financial health. That's good. 3 out of 6 dividend, 3 out of 6 valuation, and 2 out of 6 future growth. They're trading at 5.2% below their fair value. They are forecast to grow 6% per year. Earnings have grown 30% over the past 5 years and no major risks detected. Financial health, what are we looking at? 360 million to 164 in short term. And 320 to 61 in the long term. So the short term easily covers both. Nice to see. Debt to equity ratio, they are debt free with 188 in cash. 188 million, not pound. Not like me. I have 188 pound. They've got 188 million dollars. Down to dividend, we can see it's at 1.87%. That's not a bad yield. I mean, definitely not the best. It's the industry average for communications. It's forecast to grow, though. Dividend per share has not impressed me in the growth. I mean, it's been growing, I suppose. At one stage, they were 3.5% yield. It is forecast to continue growing, though. How's the coverage? Coverage is all good. Okay. Now we're on to Greggs, one of the UK's largest bakery chains, providing fresh and popular on-the-go food to consumers worldwide. Okay, Zavin, let's see. While buying shares in a glorified bakery may not seem like a prudent investing, Greggs continues to defy expectations. It turns out that selling pastries and sausage rolls can be immensely profitable. And even with the consumer spending dropping off a cliff lately, recession, the firm is still delivering double-digit sales growth. With over 2,200 stores scattered across the country, it continues to expand its operations, maintaining its vertically integrated structure. That's a pretty impressive feat of Greggs, to say the least. Beyond ensuring supply chains remain undisrupted, it provides complete control over production. This enables management to rapidly introduce new products and adapt to ever-changing consumer tastes and diets. And if you haven't noticed, with a lot of the changes in restaurants and, like any food business, we, as the consumer, we change our tastes and diets very frequently, I would say. It's resilient to wobbly economic conditions is a testament to the brand's popularity among consumers. Yet, if things worsens, households may cut back on their excursions to the bakery chain. That would obviously be bad news for the business. Nevertheless, its proven track record of success makes me bullish for the long term. He or she does not own shares in Greggs. I say that, I don't know. I'm guessing that's a guy's name. They were trading at the start of the year at £33.54. I think I had them round about the £19 mark, and I think I sold somewhere about the £20 mark when I was changing my UK portfolio. And currently they're at £23, so far higher than I ever had in, even averaging into them. There was a few questions I had about Greggs. Now, they may be solved in the coming months, but again, all the points made were good. They're good points about Greggs. We'll go over to Simply Wall Street and I'll actually show you a wee bit on that. What was the SPT trading up? I should have mentioned that. £2.60, and it started the year about £2.70. Not a massive change, to say the least. Okay, over to GRG. Greggs. I like Greggs. I've got actually a lot of the stuff from Primark. Didn't buy the cozy Crocs though. I probably should have indulged myself in something like that. Right, they're down 30% in the last year, £23.46 at the moment. Right, Dividend 4 out of 6, 5 out of 6 financial health. Past performance is decent, as is future. Values where they really don't strike out well on a discounted cash flow model. Earnings are forecasted to grow, and they have been growing over the last 5 years. Now, let me go to valuation. I'll actually show you here. They trade at a 20 times PE ratio, which is surprisingly, pretty close to competitors within that sort of field, even though I don't think they've an actual direct competitor for a bakery that size. But we can see they're on a discounted, now that's a discounted cash flow model. Greg scores 192 or 190.2% overvalued. There is a lot more involved in that. You should look at intrinsic value and alpha spread for sure on that. But down to the financial health, Greg's is pretty decent in the short term. I think, they're completely debt free with 145 million in cash equivalents. Again, that's good to see. That's 2 debt free companies we've seen so far. Wait, was YouGov also debt free? 3 debt free companies. Wow. Yield 2.43%, and it was, I like their dividend per share was growing quite nicely. It was cut over COVID, but look, it bounced back stronger than ever and is forecast to continue to grow. We will, of course, have to keep an eye on Greg's, but that's definitely one always on my watch list. As I even have a pair of shorts. I'm not wearing them right now, but maintaining a bit of professionalism here. I'm stuck. What it does? Ibstock manufactures construction products from 36 factories and is the UK's biggest brick supplier by volume. I was looking at these guys recently. I don't know if I was doing a video or what I was doing. I think it was another article. £2.08 is what they're currently at. Well, what they started the year at. They are now at £1.54. Now, the reason I was personally looking at these is I thought they might be a nice complement to my Taylor Wimpey shares, because I'm thinking maybe the house building going downhill at the moment might give a bit of opportunity to get in. Maybe it could go down even further. It's hard to make a call like that for my own portfolio, that is. But it's definitely something I looked at. So let's see. The share price in Britain's listed brick manufacturers have collapsed as worries over the housing market have grown. FTSE 250 operator IBST has lost a quarter of its value since the start of 2022. I think this decline represents a great dip buying opportunity, especially as trading news from the sector continues to impress. IBST traded ahead of expectations between July and September and announced in mid-October. It said that this was thanks to robust I need to drink a wee bit more of this coffee. Robust demand patterns and strong operational performance. Then, in late November, Brickability Group, what a name, announced like-for-like growth of 9.3% April and September. It said that it enjoyed continued strong order intake at the start and second half too. A sharp slowdown in the housing market is a risk to IBST and its peers, but a rock-solid repair, maintenance and improvement market means the sales keep impressing. Today it trades at 9.8 PE ratio for 2023, and I think this represents excellent value. Well, he owns shares. At least he's honest about that. That's one thing I like about this website. At least to point that out. IBST. Right. IBST. Let's go. Have a look. Yeah, so £1.55 at the moment, 608 million market cap. Value, 3 out of 6, but it scores 6 out of 6 in financial health, so we're going down to have a wee look at that. 3 out of 6 in dividend and 4 out of 6 in past performance, right. Good news is it's trading 60.8% below its fair value, and earnings grew 89% over the past year. Obviously, housing building basically stopped, and then it restarted after, everyone got back to work. So I'm not surprised at that. Earnings are forecast to decline, but only at 3.6% per year for the next 3 years. Now, it's a forecast. Depends how the housing market and things go. Could get worse, could get better. Depends. Are you an optimist, a pessimist? I'm a realist. I will just have to wait and see. Down to financial health. I want to look at this, though. 6 out of 6. Assets in the short term at 237 million cover both the short-term liabilities and long-term. How do they sit in the debt? 100 million in debt to a 436 million in equity. In terms of cash, they have 64 million in cash. That's pretty good. Debt's well covered, interest payments are well covered, and they've been actually reducing it over the past while. Good to see. Dividend, I want to see 5.36%. Ooh, that's nice. I don't know why it's not considered high, but it needs to be like 5.7 to be considered high. All right. Well, it seems they were killing it up to 2019, where they issued a 5.7% dividend yield and a dividend per share of nearly 15 pence. Now, they didn't pay it over COVID, but they restarted payments, and they're almost okay. Well, they're halfway to pre-COVID levels, but I wonder, was that a particularly good year? See, that's something you always have to consider. So if we go off this, they're almost at pre-COVID levels, barring that wee spike, and it's forecast to drop and then sort of rise, but still maintaining around 5% at its current value. Definitely one on my watch list. In fact, I'm going to add it to my watch list. Might even do a wee separate video on IBST. Right, who's next on our radar? Lloyds Banking Group. What it does, Lloyds is a high street bank in the UK's biggest mortgage lender. The more you know. It started the year off trading about, about 55 pence, and now it's trading at about 45 pence. Okay, by Alan. It's a stock I've held for years through ups and downs, mostly downs. But even through the tough times, it paid me decent dividends most years. I'm talking about Lloyds Banking Group. I'm about to say, if he takes the dividends out, I've held it for years through ups and downs. I thought he was talking about Boohoo stock there for a second. But it was good until it said dividends. I don't pay dividends. Would I be mad to buy a bank stock in a recession and a mortgage lender when the property is slowing? Maybe. Though a lot of people that bought bank stocks in the last recession made out like a bandit at times. Well, it depends on when you get in and when you get out. Sometimes, I guess. But right now, I see one simple reason to buy Lloyds in January. I reckon panicking investors have pushed the valuation too low. We're looking to pay multiples of under 7, which is around half the long-term FTSE 100 averages. The dividend yields are 5%, heading close to 6.5% on 2024 forecasts. The risks are real, but I know I could be in for a bumpy ride as we weather the economic storms. But does anyone really think that banks won't generate big profits over the long term, or is the UK's chronic housing shortage has ended? He owns shares. Well, he was quite positive and honest in that one. Let's go. LLOY. It was one of the first videos I did in the channel. Was it one of the first? It was definitely at the sort of start of it all. So I haven't seen them in a while. Let's see. An excellent balance sheet and good value. Yeah, decent value. Pays a dividend. Financial health's not too bad. Future performance, 1 out of 6. Currently trades at 58% below its fair value and forecast to grow earnings of 1.84%. Let's go down and see their dividend. So it sits at 4.69%. Obviously, this depends on the yield. We'll see what it opens up and trading tomorrow. But it is actually forecast to go to 6.5% next year. That's mad. And 7.5% in 2025. Forecasts. They're forecasts. But they're still impressive. They stopped paying. Obviously, UK banks didn't pay over the pandemic. So if it did reach that dividend per share in 2025, that would just be pre-COVID levels in dividend per share. There's some of the metrics you got to look at. Right. There's the next one. Victrex. They manufacture a range of polymers for use in industries such as automotive and aviation. Whoa, they started the year £24. They're now trading at £15. Ouch. That's a drop. Let's see what Christopher has to say about them. I can now buy shares in Victrex for a third cheaper than I could at the start of the year. That reflects some of the risks the company faces, such as higher energy costs eating into profit margins. Last year, gross margin fell from 54% to 51.2%. Longer term, though, I think Victrex's Victrex's business model is compelling. Its technology is used in mission-critical applications, meaning customers are willing to pay more for quality. Patents in some of the firm's polymer technology give them a unique competitive advantage. Oh, patents. That's a really interesting dive on a company, looking at the patents they've got. Last year saw sales volume grow 8%, revenues rise 11%, profit before tax fell, but still came in at 88 million. Despite smaller profits overall, earnings per share rose 4%. The business is highly cash generative, everyone loves that when it comes to dividends, and yields 3.7%. As a long-term investor, Victrex offers me the sort of solid business prospects I like at a price I find attractive. He owns shares in them. VCT, another company that I must say, a lot of these are surprising me. I would say about half of them I've never seen before. Let's go. They are an excellent balance sheet and fair value. Okay, so scoring well on, well, halfway on valuation, dividend, and 5 out of 6 in financial health. Trading at 26.7 below their fair value, estimated fair value. Forecasted to grow 8.72% per year on the earnings. Analysts in agreement that it will rise, but the dividend is not well covered. Let's go to financial health. Have we nosy? We can see short-term assets covers both long-term and short. Wow, they actually don't have that much in long-term liabilities either. Are they debt-free? Oh, they're close. They're close. 22.5 million, but they have 68.8 million in cash sitting about. Nice. We can go down dividends. Let's see. Their ex-dividend date is in fact January 19th. Obviously, you'd need to share on January 18th just to knock that home. Let's see here. How's their chart looking? Let's see. Growing their dividend per share, jumped massively in 2018. Didn't pay it in 2020, and it dipped again in 2021, and now it's back to like pre-COVID levels, barring that one jump here. What's that a yield of? 3.7? That's forecasted to grow in the next couple of years and increase their dividend per share. Right. Do you know what? You get added to the watch list. I want to have a wee look at the wee polymer company. Why not? Who's next? Fresnello. I know who you are. World's largest primary silver producer and one of Mexico's largest gold producers. I knew who that was. I've looked into this company before. £8.51 was their start of the year, and now it's about £9. Okay, so not that much has happened. They've had a few dips, almost about £6.50. Let's see what Andrea has to say about them. The last couple of years have been very frustrating for precious metals investors. However, clear signs are emerging the industry may have bottomed out. Last month, silver had its best November performance in history, as its price rose 16%. Unsurprisingly, the share reacted positively in the move and is up 25% in 6 weeks. I am of the firm belief that we are very still much in the early innings of a bull market for precious metals. What I really like about silver is that it is not only a monetary metal, but its integral role in the green revolution. Good to see that the metal has both two purposes in that one. Silver is a key component in many green technologies, including renewable power, off-grid storage, electric vehicle charging stations, and in the years ahead, I envisage a world of elevated demand and tight supply. Consequently, I believe its share price is extremely cheap after its recent rebound. You own shares. Okay, Frez. Let's go to Frez. Fresnello. Gold and silver. Yeah, future prospects looking nice over the next 1 to 3 years, and financial health for mining companies tends to be quite high. Excellent balance sheet and reasonable growth potential. Dividends not well covered and profit margins are lower. Right, financial health, 1.9 billion. Yeah, that covers short and long term. Cash and equivalents, they probably have a good bit of cash on hand. So I thought $1.15 billion sitting on hand. And their dividend, 2.51%. Wow, that is well below the industry average. That is extremely below the industry average. Wow. It's a different kind of mining firm. They actually have 140% cash payout. It's a high cash payout. That's a high cash payout when you consider that they're not even close to the industry average of metals and mining. Something to definitely bear in mind. It's actually forecasted to, their dividend per share is forecasted to go down. Okay, Fresnello. Nice looking at you. Let's go over to Scottish Mortgage Investment Trust, and the last one looks like it's Diageo. Very familiar with that one. Did a video on them very recently. Okay, so Scottish Mortgage is a global trust of 100 companies in its portfolio, including unlisted businesses such as SpaceX, and someone told me this, a subscriber, they own Epic Games. They don't own, they have shares of Epic Games, which I thought was quite cool. And there you go, SpaceX. I must do a wee bit of a deep dive into Scottish Mortgage Investment Trust, because that's pretty cool. That is pretty cool. So, by Charlie, shares in Scottish Mortgage have far from impressed this year, down 40%. But despite this, I think January could be a great time to snap up the trust. What I like most about Scottish Mortgage is that it diversifies the diversity it offers my portfolio. As a retail investor, gaining access to a variety of companies under one investment is perfect. And with cheap ongoing prices of 0.32%, this makes the Scottish Mortgage further attractive. The stock has struggled this year due to a heavy focus on growth stocks such as Tesla. And Tesla, Tesla is down at the moment. It's not looking great. That's why I bought a few shares in Tesla. Complete bias on that one. I sold ages ago and now I've bought back in because, I'm there for the long run on them. I sold them earlier, not because I didn't believe in them. I just needed the cash back then. And with racing inflation, investors tend to steer away from riskier investments. Yep, over the long run, I think exposure to growth stocks places the trust in good stead for its share price to soar. After all, it did buy Tesla stock back in 2013 for $6 a share. $6? $6? What? That's a steal. Rising inflation alongside its exposure to China could see it suffer in the near future, but as a long-term, happily snap up the shares. What's it trading at? SMT at the moment? I know I won't look too much on Simply Wall Street because I don't think it likes Scottish Mortgage that much. Yeah, it doesn't give me really anything to go on. What's their share price at least? It was £13. It's now £7.26. 23. Wow. Let's pay a dividend. 0.51%. It's been slowly growing its dividend per share, but obviously by pence. So yield ain't rising too fast. Interesting points in who they're invested in though. Tesla, SpaceX, and Epic Games. Quite the portfolio. Must actually look at it. Right, last but not least, certainly, is Diageo. They are a multinational alcoholic beverage conglomerate. It's one of the world's largest distillers. Think Smirnoff, think Guinness, think Tanqueray, gin, just to name a few. Okay, John. A recession may be looming in the UK, but it hasn't stopped consumers from drinking. As such, I think shares in Diageo, DGE, could be of great value to buy for my portfolio. Current cost of living crisis presents a headwind for many retailers, but Diageo expects its spirits to continue flying off the shelf. CEO Ivan Menezes forecasts consistent sales growth of 5% to 7% through full year 2025, with operating profit set to grow from 6 to 9%. Although these numbers aren't stellar by any means, it should protect my portfolio from the risks of a recession, the downside risks. After all, the likes of Barclays, JP Morgan and Credit Suisse have an overweight rating for the stock with an average target of £47 and 46 pence. That being said, its high level of debt to cash is something I'm looking into, as future repayments may hinder the company's ability to grow its bottom line and return more value to shareholders. The thing about Diageo is that they have a firm moat considering the brands that they have. Like all those brands I mentioned to you, plus I think they've Captain Morgan's, they've got Ciroc Vodka, they've got quite a lot. But yeah, I do think in the value department they ain't doing great though, but it's hard because it's one of them companies where I don't know if I'd ever get the chance to buy it much cheaper than it is now. Its dividend is pretty stellar, it's pretty great, growing year on year, But when it comes to financial health, I do want to point out that he is correct that it does have an awful lot of debt, 16.3 billion and only 2.4 billion in cash. Now, the debt is currently covered by operating cash flow at 24% and interest payments at 13.1%, but their debt's just been steadily growing, if anything. So it's something to look at when you're looking at Diageo. And that has been this article. I certainly enjoyed going through the best British shares to buy in January. Let me know what you think in the comments. I'll catch us all in the next one. Thank you.